Hello, everyone. Welcome to today's episode of Decoding Market in Three Moves, where we simplify the markets into three clear, actionable strategies or insights. Joining us is Mr. Rohit Srivastava, an expert market strategist and founder of Indiacharts and Strike.money, who will guide us through understanding market trends with confidence and clarity. So let's dive in and decode the market together. So, welcome back, sir, once again to our new episode.
Pleasure to be back.
So, it's a week ending, marking the end for this week and blowing for the next week. So, what are your views on the market entire week, and what are the updates that are going to come in the next coming week?
So we have a very interesting weekly closing. While it is positive, we have something on the candle side. So I'm sharing my screen now. You can see this. Candlestick patterns fascinate a lot of people, so I'm using that. They can be interesting when they happen at a particular point in time. I don't give every candle pattern importance, but you have to know how to give them importance. And once you're a wave analyst, you also give them importance based on where they come in the structure. So here you are looking at an inverted hammer. Now, this inverted hammer also comes where the real body is negative. So now I'm giving people who don't know about candlesticks a small class. You can see some of these candles are red and the entire box is filled. And then you can see some which are green where the box is not filled. This box not filled and filled also has a meaning, and the red and green also have a meaning. So usually when we think red and green, we usually think that prices have closed higher than the previous day or lower than the previous day. But when it comes to candlesticks, the color or the filling of the box essentially represents how it has done intraday, that is from the open to close. So if the closing price is higher than the opening price, it is a hollow candle like this, a box which is hollow. Hollow meaning we have not filled color inside it. And when it closes below the opening of the day, then it is a filled real body. Okay. So sometimes we call this a negative real body or a filled body. So basically, when the real body is negative, when I say that, what it means is that prices closed lower than where they opened for the day. So even though we didn't close down, the candle itself, one, it is negative. Second, it's an inverted hammer. So what is an inverted hammer? An inverted hammer is when the open to close price range is very, very small. So you see this is a small little box. It's not like a long, big box. It's a small little chota mota box. This chota mota box is sometimes called a doji or a doji star or a gravestone doji and so on. So it's a small little box happening. It's gravestone basically if the open and close are equal to each other. But if they are not equal and it's just a small box, we can call it a doji. But in this case, it's more. Why does the doji become an inverted hammer? It becomes an inverted hammer because intraday you got a big spike on the upside, a high. Now in this case, it's a weekly chart. So we are saying intra-week, and today is Friday. So we're talking about the weekly chart. You got a big move up, and then all those gains are given up. So therefore, you get a spike like this, a big line on the upside. So typical doji is when the big line up and down is not big, it's actually small. So then we just call it a doji. Okay, and if it's a cross, we call it a doji star like you see here. Okay, but if it becomes a box with a big line on top, then it becomes an inverted hammer. So inverted hammer is actually a sign that there was too much selling pressure on top and we couldn't hold on to our gains. That's what the candle says. Now, candlestick theory also says wait for a confirmation and all that. But some of us are take an advanced notice based on where we are in the wave structure or where we are in the price action. In this case, we were exactly at 61% retracement of the entire fall. And therefore, at 61%, getting resisted and developing an inverted hammer can give you a point of trend reversal. We, of course, need to see follow-up action, but this can be a sign that whatever we saw, so we saw the 6-week decline and then we've seen the 61% bounce. If there is more downside, then this bounce is over at 61% and we can start developing another leg on the way down. Now, this would be true as long as we don't go above the high we made this week, 25,154. If we don't cross that, then the trend remains slightly negative. That's what can come out of this. We'll of course, it's just 1 day red candle on the daily chart, so it's like for some people you may say it's early to say. You can wait for the RMI to give a sell signal and all that, but this is what it is. Now of course, in terms of real body, this is the second negative day, but when we go to a bar chart, okay, then no, it's not a second day. Okay, so it's just the first day. There's a slight difference between when we see a bar chart and when we see a line chart because of uh, you know uh, how it's really seen. I'm sorry, I think this is still working like a candle only. So on a regular bar chart, basically today would be just one down day, but on a candle chart it looks like two because of the real body. Okay, so now I'm looking at a normal bar chart without the candle effect. So it's just one down day. So let's see if we are able to, stay below this high. Then we've started down. I think one level where people will get more sense of this is if we actually break into this gap zone. So we closed, I think, just at the gap zone. The gap is at 24,850 odd. So let's just put that as a resistance line here, 24,850. If we go below this, the low we made today is probably around 20, is around that. Okay. And the low here is around that. Marginal difference between the two if I go down to the integers. But below 24,850 is where we start filling this gap. Now, there is a theory that all gaps get filled. I don't believe in that theory. I believe that all gaps get filled when you're in a bearish market or you're in a range bound market, consolidation. But in a trending bull market, many gaps get left behind. But if this is a corrective move, as we are saying that 61% retracement, then we should also see the gap getting filled. What would be more wild than a gap getting filled is that it gaps down and goes down from here, which means it leaves behind an island. A lot of theory I'm giving away today. For people who are new to patterns, an island is basically when a gap is left in the same price territory. Okay, on both sides. On the way up, there's a gap in the same price territory. On the way down, also there's a gap. It can also be like this, like not all the prices gap on both sides, but even if it is some of it is unfilled, like here, it is called an island. It means that the people who bought on top are left behind holding the bag. That's what a island reversal means. So we'll get that confirmation only tomorrow. Today is the first sign of a reversal. But the weekly inverted hammer was an interesting one because even though it's just a 1 day reversal, it is given back the gains of the week. And in that sense, given us a bearish weekly candle setup, which is interesting. So interesting way to end the week and leaves us thinking about the next move. Will it be again on the downside?
So in the it can be up, it can be down. We are in a very tricky situation right now, sort of.
Yeah, but I'm just giving the weight of evidence growing. Like, see, when you get something like this, you start thinking about the downside. You don't say that it will be up or down. You look for
Right.
confirmation, or you look to position size. Position size means that I will not take my entire thousand Nifty short position right away. I may deploy, say, okay, let's do 100, 10% or 20%, and then see what happens. The reason to do this, what I always explain in the mentorship program also, is that when you're in the trade, it becomes easier for you to add to the trade. Now, say for example, market gaps down 500 points tomorrow. What will you feel? You'll say, I missed it.
Right.
I couldn't short at 61% retracement. But if you short at 61% and it goes above that, you'll say, I was stupid. I didn't wait for a confirmation. There is no perfect answer. The answer is to position size. There has to be risk. Reward is only for risk. Zero risk is equal to zero reward. Okay. If you don't take risks, you don't make money in the stock market. So anybody looking at zero risk or not taking risk or hedging risk, you don't get money for doing that. You get money to take risk. So you have to learn how to take risk. Okay. And that's where position sizing or what they call as sizing up a position is a very, very important lesson for people. When you feel something, say, fine, has it reached that point? Do I have certain tools telling me that, you can be here? You start with an opening position and then you build on it. because then it's easier. If I have an opening position and the market gaps down tomorrow, I will not mind adding more to it or doubling up on it. Hey, just a second, I have to take this call.
Sure.
Yes.
So guys, you all of you can just put down your questions in the comments. As we come to the end of the session, so we will take your comments and so will answer them. But please make sure that your comments are open, not open-ended. They should be entire questions. Thank you. Yes, sir.
So yes, I think that's about it on the position size part.
So that's what that what calculated risk is. Taking risk is good. Market will give you reward, but taking calculated risk is something you should know.
Yeah, you should know how to build a position.
That's where the thing is, right? So this comes to takes me to my first question, which is as the Nifty continues to show resilience around key support levels near 24,800, like ongoing global uncertainties, how do you assess the market's near-term direction and what key indicators should investors or traders monitor for confirmation of a sustained uptrend?
So there's some very interesting things. People need to go to India charts, and I'll actually need to log in. I'm logging in because I'm going to read a paid post on uh, since you talked about global markets
Right.
on the world indices. I'll just go to world markets. It's faster. I'm not sure where did I put it. See, we write a lot of stuff. Okay. So yeah, strategy update on US markets. This is something I wrote 2 days ago. Okay, we can take it one image at a time. This is the Nasdaq or the S&P. Essentially, what they ended up doing is could see a very clear 5 wave at the end of this. So you're looking at an end point. You have a couple of things happening in the US market. One is the momentum is diverging throughout this phase negatively. This is the put call ratio. The put call ratio for the US market also diverging negatively, which means each time the market is going up, the PCR is not making a new low. It's actually making a higher bottom. So this is another thing which is giving you a negative divergence. And the third one is number of stocks that are above the 50-day moving average have actually been falling, reducing in the last two rallies. Last time here it went up in July. We made a lower top. And now again, as we are going up in August, we are making a lower top. So all these indications together, and here's another one. That's the dollar, which is completed 5 waves down in wave C. Either it's wave C complete or it's one of C and we are in two of C. If the dollar is still to be in a bear market, you're going through a dollar bounce. And you have the VIX, which is actually hitting 14. In fact, in India, we almost touched 10 twice in the last 10 days, if you didn't notice. And what all of this is trying to indicate, since you talk of global risk, is that there is some risk of a US stock market correction, which has already started. I wrote this a couple of days ago. Okay, and you've already seen the Nasdaq lose a couple of percentage points, 3 to 4% from the high. I think it has given up. I didn't expect it that fast. I thought I'll give it time. It'll happen with some zigzagging into late August or September, but we've quickly seen a move down. And even if it does bounce back, what I'm saying is broadly, we are getting closer to the end of the post-April rally for the US market, basically. And that then puts us closer to a global market correction rather than only what was looking like a domestic issue so far for India only, like tariffs. Okay. So this happens with some slowing data in the US, some limited earnings concerns. So though there is a thought that things will pick up, but some concerns and some concerns around inflation also, because all these tariffs will lead to some third quarter bump up in inflation, third or fourth quarter bump up in inflation data in the US, which will make it difficult for them to really cut rates right away, though they might eventually do so. And I think usually at this point, what happens is the market creates the environment. You create a knee-jerk reaction in the stock market, sharp enough and deep enough that the Fed is forced to change its policy. I mean, I remember it happened under Jeremy Powell. It happened in 2018. For people who don't remember, they had raised rates almost to 2.5%, thanks to Janet Yellen, who started that round. And then, moment the stock market fell, and I think it was December of 2018, it fell very sharply. He cut rates right back to below 1%. Within a meeting, he went all the way down. I don't know, 50 or 75 bips in one meeting, he cut it. It was like, "Bahut ho gaya." No, and then the stock market went up from there again. So you never know. Sometimes the market creates the situation. They've been begging for rate cuts. Trump is begging for rate cuts. Powell doesn't look. They'll crash the market and then tell him, "Boss, we need a rate cut," and then he'll give them a rate cut. It's a very silly thing that happens. Their markets behave very differently. You'll never see this kind of thing in India.
Yes, that's true.
But I hope that all that scenario will also lead to rate cuts in India. That has been my big hope long term. I don't think these two rate cuts, this dual rate cut that RBI did is the end. There's room for a lot more, especially with oil prices where they are. Imagine that this Russia and Ukraine thing does eventually work out. If not today, not tomorrow, but 1 month down the line, oil will be back to $55. So you will be faced with two headwinds. One is oil, the typical historical headwind for inflation will be going down, saying we have no inflation. And then on the other hand, it will be, oh, but we've put tariffs and therefore we have inflation, which is a US problem. It will not be an India problem. Okay, so globally, the low oil prices will lead to more rate cuts around the world. So which means the world will end up supporting liquidity, while US will still be hanging on a thread unless they are able to discount the idea that, yeah, inflation is only because of tariffs. But doesn't look like Jeremy Powell has the guts to do that while he's leaving. Like, it's similar to how our RBI governor was before he stepped off office. He just wouldn't cut rates. And the moment he left and Malhotra came in, he cut rates 4 times. So it's the same thing happening in the US. Like, this guy doesn't want to do anything because he wants to leave on a clean slate. Maine kiya, mera kaam ho gaya. I don't want to take any more risk. And the next guy will come in and do that. So, yeah, I think, but by then we will be through this corrective phase and we'll probably have more liquidity thrown at the market. Yeah. Time for the next question. Hello. Where are you lost?
Yeah, no, sir, I wasn't lost. It was a, like, I wanted to say something, but it was a technical glitch. The Wi-Fi connection is it's such a bad connection. Sometimes I feel like I wanted to say something and I end up by like freezing up my own frame.
Uh,
My ping was like
just say
there
it. Say na, just do it. वैसा है.
So no, you were in a flow. I didn't want to interrupt you in that minute because that was a great thing coming on. So let's move to the second question for today's episode, which brings us to the domestic market, back to India. So with domestic themes and consumer focused sectors getting prominence in the driving market recovery for this month, with which specific sectors do you see as the most promising opportunities for investments or trading, like looking to capitalize on Indian growth story?
Hmm. So, see, I mean, I get this question in the media also a lot and have to give the typical answer, which I don't like giving because, oh, which sector? So you have to name a sector. But it's really about, my approach has always been bottom up. It's really not top down. So top down is what? Market sector stock. Bottom up is
Right.
what? कौन सा stock अच्छा लगता है? No, I do some sector. I do have sector preferences sometimes, but those are mostly related to things that are directly impacted by macro. So what do I mean by that? You have a rising, if you have a dollar which is falling a lot and causes the commodity cycle to kick off, So commodities, which means metals, essentially are the area where I take those sector calls. So it's either going to be sugar sector, it's going to be gold mining stocks, or it's going to be the base metals, right? Steel, aluminium, and so on, copper. Now, those are sector calls that I generally take, or else I have this very macro view that India's tech sector, ever since 2000, has become a defensive sector, essentially, just like HUL. It does not give you those phenomenal returns, except if you're in some mid cap company with some new products and so on. But if you're in large cap IT, it's like a no, waste of time, according to me. FMCG has its moments. When the market doesn't do well, it does well. So these are things you learn from history. So now, if markets are doing very well, I will not do FMCG. I will not do IT. Pharma is again a selective thing because pharma has its own cycles. It sometimes suddenly does well for some reason. Particular stocks do well. They get a new contract from somewhere, and something happens. So you can't just put a simple defensive argument around pharma and leave it. But when you're truly saying that in the next phase of the bull market, which sectors would you want to have apart from metals, which is based on my commodity cycle theory that, okay, long-term commodities do well in a growth phase or in a liquidity phase, I would go bottom-up fishing, which means I have to look for individual companies that are in the high growth mode. See, remember, most of the money of the last 4 years has been made in mid and small cap stocks. Okay, and these are stocks that were either in the energy area, okay, or in some particular area. Either it was defense, it was energy, it was something or the other. Solar power, EPC contracts, make in India. There's always some theme, and within that theme, you find where is the growth. Is this company growing earnings at 50%? Fine, get invested. Look at the chart. Use your charts to get invested in that. But get invested in growth, because that is where the highest returns are going to come. So it's more a bottom-up approach. Now I'm taking a very different approach to a momentum portfolio where you actually look at companies that are doing well technically and also doing well fundamentally. And if you're able to do that mix and match, you may come out on top. So I've been trying to take that approach, because we are not in the early stages of the bull market where you can only do value investing. So when you're in 2020 COVID, you can buy anything because everything is value. PSU stocks are also value. So just buy everything. You can't lose anything. You buy Coal India at 150 rupees, gives 10% dividend. The world can fall apart and you won't lose money. So that is a different scenario. Not today, you are not there. You're still in early stages, but you have advanced somewhat in many stocks. And so if you go to some stocks that have already gone up 5x, 8x over the last 6-8 years, does that mean you don't invest in them? The answer is no, because if they are still growing at 40-50% per annum CAGR on earnings, then they are going to give you the highest rate of return over the next 5 years also, provided they are able to continue to grow. And the last year, the market has shaken out the weak and the strong stocks. The ones that are not able to grow, getting hammered. You come up with a bad guidance, like recently one company did. I think PG Electroplast or something like that. It got hammered just after their negative guidance. So you see situations like that. But at the same time, you'll find companies that have reported positive results in the mid and small cap space and moved up despite high valuations. And that should be your focus area. Because valuation is not a concern if growth is good. So you need to do that kind of research. And I'm able to do it. I'm able to do it on Strike. We are improving Strike to be able to do it faster and quicker, so that you can get these results at a click of a button rather than having to do a little bit of scanning. But the scanners are there to do the technical scan, find the stocks that are performing, then do the fundamental scan on those stocks, and there you are.
Yeah. And for everyone join in this meeting, Strike is given up a 7 days free trial. So you guys can just log into web.strike.money and can avail the 7 days of free trial. Okay. So, so this brings me to today's last question for today's episode. Like, in light of persistence, volatility, and intermittent connection, what risk management approaches would you recommend to retail investors or traders to protect their portfolios while staying engaged with the market in this phase?
So it's a very, very tricky thing, because retail investors and risk. I mean, risk is not about okay, if you do this strategy, my downside risk will get reduced. No, that's not how risk works. Risk is about research. What research are you doing? How are you entering the stock? How are you position sizing? This is how you manage risk. So people may say, no, but we can hedge. We can. Yeah, how do you hedge? Do you sell a certain amount of Nifty against your portfolio? Derivatives started in 2002 3. We've tried all these things. They're not so good always. Because many times people end up owning portfolios that are much higher beta than the Nifty. When Nifty 10% girta hai, how much it fell last year from top to bottom? From 26,000 to 21,000. Okay, 5,000 points, around 15-18%. Stocks are gone down 50%. How do you hedge in that? Then the only way is that you take a 2-3 times Nifty position short against your portfolio. But what if it goes up in that scenario? Would it help? So there is no perfect hedge over here, except that you have done the homework in choosing correctly where you get invested and you have an active portfolio management strategy. Now, if you're not an active investor, then also you can position size. You can build a position piece by piece, and that is your risk management, which is position sizing alone becomes your risk management. But beyond that, it comes down to again studying the companies every year. You need to study whether the companies you invested in have are continuing to grow, and from a wave perspective, I would say have they reached the fifth wave of their long term 5-10 year chart. If not, then you are still in trend. You still need to hold on and hang on. And if you're not so, then consider the exit. So you need to have an exit strategy. That is the only risk management that I can really speak about. So, but remember what I said in the beginning, that no risk, no return. So you just can't hedge risk and then end up with a return in the market. Okay, I think
Yeah.
thank God you're back.
So,
I was about to think that I have to go solo.
no, sir, I'm over here, but it's just a internet issue. I couldn't do anything about it.
Hmm. So I'm done with the answer. You can go to the questions.
Yeah. Could you just summarize the answer for me? Just.
There is no way to hedge risk in the stock market except to position size and do good research. Okay, everything else is just a fad.
This
But
position sizing
if you
is
have large caps, and you feel the market is doing nothing or going down, then you can do something known as covered calls. Covered call simply means that if you own certain large cap stocks, you can sell their call options in the market if those stocks are not performing, and just eat up the premium. So
okay.
sometimes that can provide you significant return and reduce the drawdown of the particular stock. But this can only be applicable to large caps that trade in FNO, not to everything else. So you can easily capture 2%, 3% returns every month through premium sales on the underlying stock.
Hmm. Got it. Like it's kind of the returns which is a regular basis in that
Yeah.
kind. Like you just invest a lump sum and you get on returns from that. Got it, sir. So let's call it a wrap up for today's session and move with the questions that are there in the comments. Starting with DV, first question for today.
Is the Nifty down to close the gap and then it may consolidate? I think he's missed my entire first 10 minutes.
Right.
I don't want to go and repeat the whole thing, but it's a possibility. We discussed in the beginning. DV, do go and listen to the recording. This will be live on all platforms as to how it can play out, what are the things to watch out for, etc.
Moving to our second question for today's is from Pradeep.
Dow trend scanner can bring it out in stock option. Oh, okay. He means that can we apply the Dow trend to stock option prices?
Uh,
Yeah, that's a fair idea. We'll look into it.
Moving to the next questions for today, sir, is from Aditya.
For how long sentiments will remain this low for our markets? Yeah, this is very interesting. Market is up from 21,000 to 25,000 and sentiment is still bad. And the reason is we've had war, we've had everything, we've had tariffs, but the market has still gone up. Why? Because certain parts of the market actually showed growth. Mid and small caps showed earnings growth higher than large caps. They recovered. Some of the large cap sectors got very oversold, so there are technical recoveries as well. But places where there was concern, like its IT sector, they got hammered. And so there's this divergence, and we are dealing with it. But the question yet remains that yes, sentiment is poor because of all this. Sentiment usually improves when we go from this stage, which is this long range bound phase we started September of last year, where you went from 26,000 all the way to 21,000. Now you're back at 25,000. You're back at 24. You may go back to 24. Will you go to 23? This up and down swinging phase, I think this year's is a little faster than 21, 22 and might end sooner. Let's see. I hope it doesn't take as long as the last time. Last time it took 18 months for it to end. 18 months would mean all the way till March of 26. But we are now coming into the 1 year time period. A lot of Indian stock market corrections end in 1 year. And 1 year would be somewhere in September, right? We peaked last year around the 28th or 29th of September. I was thinking end of August, if not end of August, maybe by end of September or in between somewhere. Once the tariff news is final that India and US have a deal, don't have a deal, they're putting additional tariffs on us, all that. It's all said and done. I think the worst will be over and priced in. So that's where we are very, very close to the end of this negative sentiment period. After that, it's going to be a bed of roses, if you really believe me.
So it's a wrap up for today's session, sir. So thank you everyone for joining today's seminar. And we'll be right back on Monday, same time, same place. Thank you everyone for joining. Thank you, sir,
Thank
for a
you.
lovely discussion and entire brief on the market. It was a very good session. Just one problem was there. That was my internet connection. I will try to fix it for the next session.
Yeah.
Thank you, everyone. Thank you, sir.
Thank you. Thank you, Sudhit.